Just one. BB, welcome to the Byte-Size Brief. Today we are putting Amazon, AMZN, that's AMZN, completely under the microscope. Let's get into it. Host 2, the analyst. Yeah, and honestly, there is a lot to get into today. Host 1, BB, oh, for sure. I mean, think about this for a second. They just delivered an absolute blockbuster fourth quarter earnings report for 2025. Host 2, the analyst.
Right.
A massive beat across the board. Host 1, BB, exactly, like shattered Wall Street's expectations. So logically, as a listener, you would expect the stock to just skyrocket, right? Host 2, the analyst, you would think so, yeah. Host 1, BB. But instead, the moment the market closed, investors completely panicked. They hit the sell button so hard, they wiped 13% off the value of the company in after-hours trading. Host 2, the analyst. It really is one of the most fascinating market reactions we've seen in years, because when you actually look at the underlying data from that Q4 report, it looks spectacular on the surface. Host 1, oh totally, Host 2, the analyst. I mean, we're looking at a quarter where global revenue hit $213.4 billion.
Host 1, BB, which is just a crazy number. Host 2, the analyst. It's a very healthy 14% year-over-year increase. And operating income was $25 billion. By every traditional metric, phenomenal. Host 1, BB. Right, so it's exactly like looking at a friend's social media feed. On the outside, they just posted like in this huge corporate promotion, Host 2, the analyst. Yeah, the shiny new life. Host 1, BB, exactly. They bought a gorgeous new mansion, the cars are shiny in the driveway, everything looks flawless. But then you look a little closer at the inside financials, and you realize they just maxed out 5 different high-interest credit cards to pay for it all. Host 2, the analyst. That is a highly accurate way to frame the core debate that is, honestly, fracturing institutional investors right now. Host 1, BB, the mansion versus the credit cards. Host 2, the analyst. Precisely. Half the market looks at AMZN and sees a company building an unassailable generational moat. They see the mansion. Host 1, BB, right. Host 2, the analyst.
The other half looks at their spending trajectory for the upcoming year and sees a company burning through cash at a rate that is, frankly, alarming. They see the credit card bills. Host 1, BB. Okay, so compared to last quarter, what actually moved the needle here? Host 2, the analyst. To understand the shift, we really have to look at the sequential changes, both the incredibly positive ones and, well, the one massive red flag that caused the stocks to drop. Host 1, BB. Start with the good stuff. Host 2, the analyst. Sure, so on the positive side, their cloud computing division, AWS, saw its growth reaccelerate to 24%. Host 1, BB. Wow. Host 2, the analyst. Yeah, hitting $35.6 billion in the quarter. That is the fastest growth rate AWS has seen in 13 quarters. Host 1, BB, that's huge. And what about ads? Host 2, the analyst. Advertising revenue jumped to $21.3 billion. Plus, their free cash flow for the trailing 12 months was an incredibly healthy $139.5 billion. Host 1, BB. Wait, before we drop the bad news, let's make sure we are all on the same page here. Host 2, the analyst. Good idea. Host 1, BB. Because, for the listener who isn't staring at balance sheets all day, free cash flow is essentially the actual cash left in the bank after a company pays for its day-to-day operations and physical capital investments, right? Host 2, the analyst. Exactly. It's the lifeblood. Host 1, BB. It's the money they can actually use to reward shareholders or buy back stock or just weather an economic storm. And trailing 12 months just means we are looking at the hard, actual performance of the past year. Host 2, the analyst. Right. It is the ultimate measure of a company's financial health and flexibility. Having nearly $140 billion in free cash flow makes AMZN a financial fortress. Host 1, BBB. Here we go. Host 2, the analyst. The red flag came from management's forward-looking guidance for their 2026 capital expenditure, or capex. They announced a planned capex of $200 billion. Host 1, BB. $200 billion. With the B, Host 2, the analyst. With a B. Just let that number sink in. That is a staggering 53% increase from their 2025 capex of $132 billion. Host 1, PB, that is an insane jump. Host 2, the analyst. It completely blew past Wall Street's expectation, which was sitting at around $146.6 billion. Host 1. So they overshot estimates by more than $50 billion. Host 2, the analyst, exactly. Host 1, BB. Hold on. How does that actually affect AMZN's stock price for regular investors like me? Doesn't spending money to make money usually excite Wall Street? Host 2, the analyst, generally yes. Host 1, BB. I mean, usually when a massive tech company says they are investing heavily in their future, the market cheers because it means growth is coming. Host 2, the analyst, that's normally how it works. But the sheer unprecedented scale here changes the math entirely. That $200 billion capex exceeds their entire trailing 12-month free cash flow. Host 1, BB. Oh, wow. Host 2, the analyst. Yeah. What this means in practical terms is that AMZN will very likely operate with negative free cash flow in 2026. Host 1, BB.
So they're literally spending more cash than their massive globe-spanning business is actually generating. Host 2, the analyst. Precisely. The market had been pricing in a narrative of cash flow expansion. Host 1, BB. Like they expected the harvesting phase. Host 2, the analyst. Investors expected them to start harvesting the profits of their previous investments and returning that value to shareholders. Instead, they were handed a narrative of severe cash burn. Host 1. That pool of free cash flow is suddenly just being drained. Host 2, the analyst. Drain fast. Host 1, BB. Wow. Okay, so we are moving from how much they're spending to what exactly they're buying with that $200 billion. Host 2, the analyst. And it's highly targeted. Host 1, BB. Yeah, because you don't just accidentally spend $200 billion. You are buying something highly specific. And looking at our sources, this is a total all-in pivot toward AWS and artificial intelligence. Host 2, the analyst. It's an unprecedented AI arms race, and AMZN is deploying capital at a historic rate to ensure they do not lose. Host 1, BB. What's the first big move? Host 2, the analyst.
First, they are locking down a monumental $50 billion strategic investment with OpenAI. Host 1, BB. $50 billion just to OpenAI. Host 2, the analyst. Yeah, and this deal is massive because it makes AWS the exclusive third-party cloud provider for OpenAI's frontier models. Host 1, BB. And just to clarify, when we say frontier models, we are talking about the bleeding-edge AI systems, right? The massive next-generation neural networks pushing the absolute boundaries of what AI can do. Host 2, the analyst. Exactly. These are the models that require the most compute power on the planet to run. And when you combine that OpenAI exclusivity with their existing partnership hosting Anthropic's Claude models, Host 1, BB, oh, right, the Claude models. Host 2, the analyst. Right. Their platform, Amazon Bedrock, is aggressively positioning itself as the ultimate enterprise AI hub. If a Fortune 500 company wants to build custom AI tools, AMZN wants to be the only logical place to do it. Host 1, BB. But hosting the world's most powerful AI models requires an unbelievable amount of specialized hardware. Like, you can't just run these things on a standard laptop processor. Host 2, the analyst. Not even close. Which is why a massive chunk of that $200 billion is going straight into building out new high-density data centers. Host 1, BBBB. And the chips inside them, right? Host 2, the analyst, yes, deploying their custom-designed silicon, specifically their new Trainium 3 chips. Host 1. Explain the mechanism there for a second. Why are they building their own chips instead of just buying them from a supplier like everyone else? Host 2, the analyst. Because standard off-the-shelf AI chips are incredibly expensive and generalized. By designing the Trainium 3 chips specifically for their own architecture, they strip out unnecessary components. Host 1, BD. Making it leaner. Host 2, the analyst. Leaner and cheaper. The result is a chip that offers a 40% better price-to-performance ratio than the previous generation. Host 1, BB, 40% is huge. Host 2, the analyst. It lowers their internal costs and allows them to offer cheaper AI processing to their clients. The demand is so intense that they've stated that Trainium 3 chips are entirely sold out through mid-2026. Host 1, BB, that's wild, sold out for months. Host 2, the analyst. However, it is crucial to benchmark this against the broader industry. The hyperscaler capex war is fierce right now. Host 1, BB. Wait, real quick, hyperscaler. We are talking about the massive tech giants who dominate global cloud computing, right? Host 2, the analyst. Yes, essentially the big three, AMZN, Microsoft, and Google. Host 1, BB. Got it. Host 2, the analyst. And while AWS grew at an impressive 24% this quarter, Microsoft's Azure grew at 39%, and Google Cloud Platform grew at 32%. Host 1, BB. Right, but what does all that actually mean for Amazon AMZN investors? Host 2, analyst. Well, Host 1. Because if Azure and Google are growing faster by percentage, is AMZN actually winning the war, or are they falling behind despite spending $200 billion? Host 2, the analyst. It comes down to absolute scale and future acceleration. While AWS has a lower percentage growth rate, they are growing from a significantly larger base. Host 1, BB. Right, the math of big numbers. Host 2, the analyst. Exact 24% growth on AWS's massive revenue adds more absolute dollars than a higher percentage on a smaller competitor. Host 1, BB. That makes sense. Host 2, the analyst. And the hard data suggests these heavy investments are going to pay off. Analysts at UBS predict that because of the Trainium 3 chips and the exclusive OpenAI deal, AWS growth will actually reaccelerate to roughly 38% by the end of 2026. Damn. Host 1, BB. Oh, wow, up to 38%. Host 2, the analyst. Yes. Furthermore, AWS currently has a massive backlog of $244 billion in unfulfilled commitments. Host 1, unfulfilled commitments. Meaning, customers have already signed the contracts and committed the money. AMZN just needs to build the servers to flip the switch. Host 2, the analyst. Exactly. The demand is definitively there. They just need the physical infrastructure to process it. Host 1, BB. So basically, it's kind of like Amazon, AMZN is buying up all the commercial real estate in the AI world before anyone else can even get a mortgage. Host 2, the analyst. That's a great way to put it. Host 1, BB. They are building the roads, the power grids, and the foundational office buildings for the next decade of tech. And they're willing to go deep into the red today just so they can own the entire city tomorrow. Host 2, the analyst. That is a perfect way to conceptualize it. They are securing the foundational layer of the next technological era. Host 1, BB. Man, the scale of that is just mind-blowing. Host 2, the analyst. It really is. But, while the cloud division is spending billions on chips and data centers, physical retail has its own massive hurdles to clear. Host 1, BB. Oh, right, the retail side. Because looking at the macro environment, the new administration's tariff policies are officially going into effect in early 2026. Host 2, the analyst.
Yes, and that brings up some very sensitive market dynamics. Host 1, BB. And before we go any further, I just want to state clearly to the listener that we are impartially reporting the contents of the source material regarding these policies and Jassy's response. Host 2, the analyst. Right, taking absolutely no political sides here. Host 1, BB. We're just looking at the math and the business strategy.
So how is CEO Andy Jassy navigating these rising supply chain costs? Because moving physical goods across borders is suddenly getting a lot more expensive. Host 2, the analyst. Well, Jassy recently acknowledged that prices on some products have started, in his words, creeping up as these new tariffs costs filter through the global supply chain. Host 1, booby. Makes sense. Host 2, the analyst. But strategically, he is framing this disruption as an opportunity. He explicitly drew a parallel to the COVID-19 pandemic. Host 1, BB. Wait, how so? The pandemic broke the supply chain entirely. Host 2, the analyst. True, but during that disruption, AMZN actually gained meaningful market share. Host 1, BB. Because everyone was forced to shop online. Host 2, the analyst. Exactly. When physical stores closed and smaller websites couldn't guarantee shipping times, consumers and businesses flocked to the one platform they trusted for vast selection and reliable fulfillment. Host 1, BB. And he thinks tariffs will do the same thing. Host 2, the analyst. He believes that in a high-tariff inflationary environment, smaller retailers will simply lack the capital to absorb the costs. They will have to raise prices aggressively.
Host 1, BB. Right, because AMZN can just eat some of that cost. Host 2, the analyst. Yes, with its massive, highly optimized logistics network, it can absorb more of that shock, driving even more volume toward their platform. Host 1, BB. But they aren't just fighting traditional domestic retailers anymore. Host 2, the analyst. Not at all. Host 1, BB. They are fighting the ultra-value rivals out of Asia. You have platforms like Temu and Shein that have completely reshaped consumer expectations around price. Host 2, the analyst, is a huge shift in retail. Host 1, BB. Like if I can buy a phone case for 99 cents on Temu, I don't want to pay $12 on Amazon. How are they responding to that specific threat? Host 2, the analyst. They're launching a multi-front counteroffensive. First, they are rolling out new storefronts specifically designed to combat those ultra-low prices. Host 1, BB. Oh, I saw this. Amazon Haul, right? Host 2, the analyst. Yes, Amazon Haul, which strictly features items priced under $10, and Amazon Bazaar for mobile-centric emerging markets. Host 1, BB. Okay, but how do they get sellers to list things that cheap? Host 2, the analyst. To get the sellers to actually list those cheap items, they are aggressively slashing commission fees. For instance, in Europe, the commission for clothing and accessories priced under 15 euros is dropping from 7% down to 5%. Host 1, BB. But hold on, if they're cutting their commission fees to just 5% to stay competitive with Temu, their retail operating margins, which are already razor thin, must be getting totally squeezed. Host 2, the analyst. Absolutely squeezed. Host 1, BB. They have to make up those margins somewhere else in the physical warehouse process. Is that what is driving this massive robotic automation push we're seeing in the sources? Host 2, the analyst. You hit the nail on the head. That margin pressure is the exact catalyst for their ultimate efficiency play. Host 1, BB. Okay, tell me about the robots. Host 2, the analyst. AMZN has officially acquired Fauna Robotics, a startup that builds bipedal humanoid robots. Host 1, BB. Wait, bipedal, like robots walking around on two legs. Host 2, the analyst. Yes, they aren't just robotic carts moving shelves around, which they already use. These are humanoid robots with arms and legs that can operate in warehouse spaces specifically designed for humans. Host 1, BB. That is literally out of a sci-fi movie. Host 2, the analyst. They can reach, grab, and pack. And the internal strategy documents reveal a staggering goal. They plan to replace or avoid hiring over 500,000 human jobs by 2027 using this robotic automation. Host 1, BB. 500,000 jobs. Host 2, the analyst. Yes. Host 1, BB. That's an entire city's worth of jobs. Host 2,
the analyst. The financial mechanism behind this is pure scale. By deploying humanoid robots, they aim to save 30 cents on every single item that is picked and packed in their fulfillment centers. Host 1, BB. 30 cents per item. And they ship, what, billions of items? Host 2, the analyst. Exactly. When you ship billions of packages a year, 30 cents an item equates to billions of dollars in saved operational costs. Host 1, BB. Okay, I have to push back here. Host 2, the analyst. Go ahead. Host 1, BB. First of all, replacing 500,000 human workers with robots is going to be an absolute PR and regulatory nightmare. Host 2, the analyst. Oh, undoubtedly.
The cultural risk is massive. Host 1, BB. But beyond that, if they're automating 500,000 jobs and saving 30 cents an item, why are they raising fulfillment fees for sellers by 8 cents? Are they padding their margins while blaming the macro environment? Host 2, the analyst. That is exactly the tension financial analysts are pointing out right now. While Jazzy publicly states they want to keep prices low for the consumer, the reality is that they answer to Wall Street. Host 1, BB. So it's about the bottom line. Host 2, the analyst. Always. By raising the fulfillment by Amazon or FBA fees by 8 cents, they are aggressively protecting their own profit margins and forcing the third-party sellers to absorb the inflationary shock. Host 1, BB. And it isn't just the third-party sellers getting squeezed to pad these margins. Host 2, the analyst. No, it's not. Host 1, BB. This aggressive monetization is hitting the everyday consumer right in the wallet, which brings us to the most visceral part of our research today. Let's talk about the Prime ecosystem. Host 2, the analyst. Right. In April of 2026, they are rolling out a new subscription tier called Prime Video Ultra. Host 1, BB. Oh, here we go. Host 2, the analyst. They're increasing the price of the ad-free streaming tier by $2, bringing it to $4.99 a month, or roughly $46 a year. Host 1, BB. Just to watch without ads. Host 2, the analyst. But it's not just a standard price hike. They are actively degrading the base tier. They are locking previously standard features, specifically 4K Ultra HD resolution and Dolby Atmos spatial sound behind this new paywall. Host 1, BB. And retail consumers are absolutely livid. Host 2, the analyst, very much so. Host 1, BB. We look at the passionate retail perspective from the Amazon Prime subreddit, and the backlash is massive. You have users who have been loyal subscribers for 15, sometimes even 18 years, canceling their memberships outright. Host 2, the analyst. The sentiment is definitely shifting. Host 1. And it's not just the video paywall. They are citing a whole laundry list of systemic issues. They are buying items listed as new that arrive clearly used. Host 2, the analyst. Quality control issues. Host 1, BB. Big time. We saw complaints about people buying a dresser, waiting 4 or 5 days for what used to be guaranteed 2-day shipping, and when they open the box, half the hardware is missing. Host 2, the analyst. That's incredibly frustrating for a premium service. Host 1, BB. They're literally using the term shitification to describe the platform, just complaining about sitting through 10 minutes of brain-rotting ads just to watch a single episode of a show like Fallout. Host 2, the analyst. The consumer sentiment is undeniably toxic in those forums right now. However, we have to look at the mechanisms driving this from a business perspective. Host 1, BB. Right, the cold hard math. Host 2, the analyst. We have to contrast that vocal outrage with the hard financial numbers. The advertising revenue for the quarter hit $21.3 billion. Host 1, wait, $21 billion just from ads. Host 2, the analyst. Yes, that is a 22% increase year over year, and it's highly lucrative. Host 1, be that as an insane amount of ad revenue. Host 2, the analyst. Even if a fraction of users cancel their Prime memberships in protest over the video paywall, the sheer volume of ad revenue makes up for it. Host 1. Because they're serving ads everywhere now. Host 2, the analyst. Everywhere. They generate billions from intent-based search ads on the retail site where brands pay to be at the top of your search results, combined with the commercials now forced into Prime Video. Host 1, BB. So for Wall Street's free. Host, the analyst. For Wall Street, the math works perfectly. The ad dollars far outweigh any lost subscription revenue. Host 1, BB. But doesn't this eventually break the Prime flywheel? If you degrade the consumer experience to squeeze out ad dollars, doesn't that fundamentally threaten Amazon AMZN's core retail moat? Host 2, the analyst. It is a calculated, deeply cynical risk. Host 1, BB. I mean, if convenience drops, elasticity changes, right? Host 2, the analyst.
Exactly.
But management is betting that the switching costs for consumers are simply too high. Host 1, because people are just too entrenched. Host 2, the analyst.
Right.
When a household relies on AMZN for their groceries, their cloud storage, their entertainment, and their daily essentials, untangling from that ecosystem is incredibly difficult. Host 1, BB. Yeah, you just keep paying. Host 2, the analyst. They are testing the absolute limits of consumer elasticity, betting that the underlying convenience of the everything store will ultimately trump the annoyance of missing features and more ads. Host 1, BB. It is a bold bet to make with your most loyal customers. Host 2, the analyst. Definitely. Host 1, BB. But as if dominating retail, streaming, and terrestrial cloud computing isn't enough, AMZN is taking a huge chunk of that $200 billion infrastructure spend and blasting it into low Earth orbit. Let's talk about space. Host 2, the analyst. This is the long-term wild card for the company. Project Kuiper has been officially reborn and rebranded as Amazon Leo. Host 1, BB, Amazon Leo. Host 2, the analyst. Yes, they are launching commercial service in the first quarter of 2026. Host 1, so right now. Host 2, the analyst, right now.
To pull this off, they're spending an incremental $1 billion this year alone to deploy a massive network of 4,500 satellites. Host 1, BB, to compete with Starlink. Host 2, the analyst, to compete directly head-to-head with SpaceX's Starlink. Host 1, BB. Wow. So they're going after the global broadband market, just trying to get internet to people living in rural areas who don't have it. Host 2, the analyst. That is the consumer-facing narrative, yes. Host 1, BB. There's a catch. Host 2, the analyst. They are targeting the estimated 400 to 500 million households globally that currently lack reliable internet connectivity. But the true strategic edge, and where the real money is enterprise edge computing. Host 1, BB. Let's unpack that. What does edge computing look like when it involves a satellite network? Host 2, the analyst. They are rolling out specific LEO Ultra antennas. These will allow massive multinational businesses and government entities to connect their operations directly into the AWS cloud. Host 1, BB, without using regular internet. Host 2, the analyst, exactly, without their data ever touching the public internet.
If you are a global bank or a defense contractor, you don't want your highly sensitive data bouncing around public fiber optic cables where it can be intercepted or delayed. Host 1, BB. So it's closed loop. Host 2, the analyst. Amazon Leo provides an end-to-end encrypted pipeline from space straight into an AWS data center. Host 1, BB. So basically, it's kind of like Amazon AMZN is building their own private secure internet in the sky specifically for AWS customers. Host 2, the analyst. Exactly. No public traffic, no local internet service providers, just a direct, invisible pipe to the cloud. And the competitive advantage is stark. Host 1, BB. Because no one else has this. Host 2, the analyst, right? No other hyperscaler, not Microsoft Azure, not Google Cloud, can offer a converged cloud and connectivity package like that because they don't own a satellite constellation. Host 1, BB. But Starlink does. Host 2, the analyst. True, but Starlink doesn't own AWS. Host 1, BB. Oh, that is a huge point. Host 2, the analyst. However, the execution risk here is monumental. This is a $10 billion plus capital debt against an incredibly entrenched competitor.
Starlink has a massive 5-year head start, proven launch logistics, and millions of active subscribers. Host 1, BB. So if Leo stumbles up, Host 2, the analyst. If Amazon Leo suffers launch delays, regulatory hurdles, or fails to gain enterprise traction, it will go down as a massive capital allocation error that will drag on their returns for years. Host 1, BB, man, this has been an incredibly revealing journey through the sources. Let's bring it all together. What is the ultimate takeaway here? Host 2, the analyst. If we synthesize the broader picture based on all the data, the tension is clear. Yes, the $200 billion capex means the company is going to face negative free cash flow in the short term. Host 1, BB, they are burning a ton of cash. Host 2, the analyst, they're burning cash. That is a tough pill for some investors to swallow, hence the 13% stock drop. However, with an average Wall Street price target of $278.80, Host 1, it's just what, like a 40% upside? Host 2, the analyst. Nearly a 40% upside from current levels, yes. The institutional consensus is that this massive spend is not a mistake. Host 1, BB.
It's the cost of winning. Host 2, the analyst. Exactly. It is a necessary aggressive phase to secure unquestioned dominance for the next decade of AI, logistics, and cloud computing. Host 1, BB. It really makes you step back and look at the sheer, terrifying scale of what they are building. I want to leave you with a final thought to mull over. Host 2, the analyst. I'd love to hear it. Host 1, BB. If AMZN successfully executes this master plan, if they control the foundational AI models that businesses run on, the custom silicon chips powering those models, the physical data centers hosting them, the humanoid robots picking the physical goods, and a private satellite internet network connecting the entire globe, are we still looking at a traditional publicly traded company, or are we looking at an entirely self-sustaining digital nation? Host 2, the analyst. That is a profound question. Host 1, BB. All right, listeners, what's your take on the future of Amazon, AMZN? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.